Hi, good evening, and welcome to today's webinar. My name is Sara Waqar. I bring to you over 12 years of experience in the financial markets, both as a prop trader and as a financial educator. My expertise spans derivatives across trading, currencies, commodities, and stock indices. I'm licensed from FINRA in USA and from the Capital Markets Authority in the UAE as an investment manager. Over the years, I've helped individuals from a wide range of professional professions and backgrounds in developing effective trading strategies and sound risk management practices, as well as the discipline which is required for long-term performance in the financial markets. So, welcome to Amana. Amana is a leading brokerage with a 15-year track record of providing world-class trading experience to traders through advanced technology, reliable execution, and dedicated customer support. We're regulated both locally and internationally, locally from DFSA and from ESCA or CMA, and also from SPCX in Europe, from CMA in Lebanon, LFSA in Malaysia, and also from we have a strong focus on the MENA region. We provide access to both regional and international markets. So from our platform, you can trade across a wide range of financial instruments and multiple asset classes like stocks, currencies, commodities, indices, and ETFs. And if you have any questions, please feel free to drop them in the Q&A section. So there is a chat section, and in the Q&A section, if you want to ask me any questions, please drop them in the Q&A section, not in the chat. So if you want to contact us further, you can email us at support@amana.app, or you can call us directly, contact our live support through the website, or reach out to your relationship manager if you have one. Currently, we are running this very exciting promotion at Amana, which involves a $1 million prize pool as straight credit. So in that, you have to guess the FIFA World Cup champion. How do you participate in this promotion? You simply download the Amana app and you register. If you haven't done that already, then you will just submit your prediction for the team you believe would win the World Cup. Fund your account with $1,000 and take a minimum of one trade, and that qualifies you for participating in this prize. So predictions have to be submitted till the 5th of July, and there's a total prize pool of $1 million, which is going to be shared equally among all eligible participants who have correctly predicted the winner. So if there are 100 people who have predicted correctly, then about $10,000 each will go in your trading accounts as trade credit. That is not withdrawable, but any profit that you make on top of this is withdrawable. And I encourage everybody to review the full terms and conditions, which are on our website. I'm also going to be pasting this link in the Q&A. So if you want more details, you can just wait, I will do this in the chat section. Oh, here you go. So you can view the details of this promotion here. So today's webinar is about the current market opportunities and how to trade them. Before I begin, please read this disclaimer. So this webinar is really going to focus about the current situation and the macroeconomic forces which are in place right now at the moment, and how, using all the information that we have right now, we can invest or look at different asset classes. So the first thing that everybody knows is the geopolitical tensions and the conflict that we have right now. And as we all know, that this started, in late February, and it resulted in a near total closure of the Strait of Hormuz, through which approximately 20% of the global oil supply transits. And that single event drove the prices of oil up to almost $117 per barrel. That increased global inflation, and that pushed the Fed towards a hawkish stance. Okay, so the Fed is the Federal Reserve Bank of the US, or the central bank of the US, and a hawkish stance actually means, that the Fed is thinking about increasing interest rates because of the increased inflation. So increasing interest rates are used to control inflation. So right now the situation is that 9 out of 18 of these FOMC committee members, or at least half, are expecting that the Fed would or might increase the interest rates in the future, and that has an impact or across all markets. So it will have an impact on the commodities, on gold prices, on the equities, on crypto assets, and everywhere. Then the third is the AI boom. So the equity markets at the same time, they're in a structural super cycle, and that is because of this AI boom. And we can see that all the big companies like Nvidia, Marvel, Alphabet, and Google, Microsoft, they all continue to surprise us with greater than expected earnings, and that is actually driving up the prices of equities. So if you look at the situation, on one hand, we have this strong AI earnings, which are pulling the equities higher. And on the other hand, we have this issue of inflation and the Fed trying to reduce the effects of this inflation through, considering increasing interest rates. So now what we will do is we will be looking at different asset classes one by one. So first, if you move towards the US equities, in the long term, we know that this is a clearly bullish market. And I have discussed this many times before as well in the webinar. So looking at the weekly time frame of S&P 500, which is an index of the top 500 US blue chip companies, and it's taken as the best benchmark of the US equity market. This has been in a very clear bull run for the past over 2 years. And this is the weekly chart of the S&P 500. And as we can see that this is undisputedly a bullish market. And a lot of that has got to do with all of these AI companies and, the AI boom. And this is actually what is supporting this bullish run. So if we also look at Nasdaq 100, which is more heavily weighted for tech companies, so it includes the top 100 non-financial companies and is more heavily weighted for tech companies. Again, we see the same picture. This is a very clear long-term bullish trend. By the way, the Nasdaq has outperformed S&P, and it usually does that because most of the performance or the earnings is coming from the tech companies. So in the past 1 year, the Nasdaq has actually given us a phenomenal return of 50%. So if you go down on the Amana app, just select the instrument that you want, whose performance you want to look at the top on your watch list, like I did. So if you select Nasdaq here and then just scroll down, you will just see the performance. So the 1 year performance is 50%, and that is unleveraged, and that is completely phenomenal. If we compare it with the S&P 500, then the last 1 year performance of that is 30%, which is again huge. So all these indices have been hitting their all-time highs again and again. And there has definitely been volatility, and that volatility comes whenever there is a certain announcement, such as the Fed meetings, such as, maybe inflation report, etc. However, we see that despite all of these, overall the indices remain bullish. So what are the main reasons for this bull run? The first, which I just talked about, is the chip and the tech account for 40% of the S&P 500 upward earnings. Then we had data from the jobs market or the labor market, which actually showed that the labor market in US has improved, and more jobs have been created than what was expected. And that too has actually led to a bull run. The third is the geopolitical relief, because we know that there are ceasefire talks between US and Iran, and that has also somewhat eased the tensions and has lifted the equities. So how do you look at this market again for S&P? I think that one important support would be around this area. So if I just draw the support line, so this is one important support line, and as long as the prices remain above that, and they would remain buoyant, and we can actually consider any consolidation above this line to be more like market noise. But if this line is broken, then we can actually, consider that some bearish factors have come into play, which are, causing money to flow out of equities. One of the reasons that I just discussed was that the Fed is considering raising interest rates, and that always has a negative impact on equities, because money tends to flow out of equities and more into savings, which are now promising higher interest rates. So again, a break below this level which I showed you would be the first sign of bearishness, but anything above that is more or less bullish. Then we go on to gold and silver. So I think a lot of people right now are looking at the market and they have different opinions and they are confused, and I think that's quite valid. So both of these metals, as we know, they hit extraordinary highs in early January 2026, and that was driven a lot by geopolitical fear, and they have corrected massively since then. So in January, we saw gold going to a high of 5,595 per ounce, and now it sits at around 4,200, and that's a 25% drop from its high. And silver, which is definitely more volatile than gold, reached a high of $116 per ounce and now sits at around $66. So if I go here and if you look at the price charts of gold first on the weekly, so yes, this spoke about this particular price action in my earlier webinars, and I said that this is a very important support line, and if this is broken, then definitely the structure would be disturbed. So overall, if we look at this market, we see that from historical levels, it is gold prices are much higher. And if I look at the performance of gold in the last year, despite this correction, let's find out what kind of return has gold given despite this correction. That's 22%. So it is 22% up in the last 12 months, which is again, a significant return if it's used as investment despite this correction. So I think that a lot of people are looking at the metals not as being, in a bear market, but actually repricing themselves and correcting themselves to come to a more realistic price level. So we would not say that this market, like, the metals are losing value, but rather than they are actually correcting from those massively overpriced levels that they actually hit in January. So what are the reasons? What could be some of the most important reasons why this is happening? Again, the first reason is that Fed's hawkish stance on the interest rates, which means they are considering increasing interest rates, or they have signaled lightly that they might raise the interest rates in the future. So since gold does not generate any income or any fixed returns, that is why money is flowing out of the metals. Second thing is also that the dollar has strengthened. So the dollar index has touched over 100, which means that the dollar has become stronger, and dollar denominated commodities will become more expensive for foreign buyers, which is reducing the demand for metals for the near term. The third thing again is that the Iran conflict has led to inflation, and that inflation is reinforcing the rate hike stance, which is again pressurizing the metals. If we go to silver, and if you look at silver, which is again more volatile than gold, so this is silver. So again, it's a very similar price chart, and the 12-month return for silver, sorry, where's my watch list gone? So the 12-month return for silver has been 70%. And this is because percentage-wise, silver is much more volatile than gold. And I had a webinar which discussed the relationship and the dynamics between gold and silver, which is now uploaded on the Amana YouTube channel. So if you want to explore the detail of how gold and silver are correlated and how, percentage-wise you can sit through that webinar. So again, despite the correction, gold and silver are historically at high levels, very high levels, and they are in the certain correction phase because of some of the reasons that we have discussed. Now, what could be some of the reasons why we feel that overall, structurally, this market will still find support and remain bullish in the long term? One is that there's massive buying by the central banks, especially from Poland and China for gold. And there's de-dollarization. So central banks all across the world are they're reducing the dollar reserves, increasing the gold reserves, which is actually real structural demand for golds. Then we've got these EV and solar demand causing deep industrial supply constraints, which would give support to the price of silver as well. So metals are still well above levels from 2 years ago, and we can watch for support and structural drivers, which could actually lend support to these metals. So right now, my strategy would be just to be on the sidelines and keep an eye on the macroeconomic factors and look out for any particular consolidation phase that happens in gold and silver, followed by price action signals, which could signal bullish behavior entering back into the market. Next, let's move on to oil. Okay. So oil, as we know, is very sensitive to the geopolitical situation and to the crisis. And we know that before all of it began, Brent was approximately at $71 per barrel before this conflict began. And then during the conflict, it spiked to 117 because of the Hormuz closure, and that cut off almost 11 million barrels per day of the Middle Eastern supply. And what is happening now is basically a retracement from those crisis highs. It's not actually a decline, but it is the oil price going back to normal. So if I go and look at the Brent chart, so again, this big move upwards was because of the conflict. And again, if you see that the market has corrected itself and is actually gone back to the average price that it was before. And the same is for WTI, which is the American oil. So it's a very similar structure. So what can we actually expect now from oil? So oil, again, like I said, is specific to the geopolitical situation. And as we know, the ceasefire talks are going on, and it's very sensitive to the headlines, basically. So the first reason why oil has slid is the peace deal expectations are very high. So most people are expecting a ceasefire and a potential Strait of Hormuz reopening, and that is what's causing the oil to slide. Okay. Apart from that, there's US supply of oil also stepping in. So American crude and petroleum product exports have actually hit record highs because of this conflict, because the Europe and Asian markets have replaced this lost Middle Eastern supply with the US barrels. So there could be three cases. If the strait reopens and we have concrete ceasefire deals, then Brent would probably, fall to 79 or below. If there is an escalation case, then again, you could see the price of oil going up, and it depends on the intensity of the escalation. So again, it could be driven up to, something like, 100 or 105. And if there is an OPEC intervention because of the decline in price, which actually cuts OPEC profits, then OPEC has the option to cut production as well. So if it does that, then in that case, it could, give another push to the price of oil. But that just depends on OPEC. So these are some of the things that we need to watch for now in this market. So going back, if you look at and if you make a comparison with the historical prices, so we are pretty much at a historical average price right now, and again, everything just depends on the current situation, on the headlines, on which side the conflict goes. Next, I'm going to be talking about SpaceX, which is, everybody got everybody excited because it was the biggest IPO in history. And SpaceX is now available on Amana to trade as well. And I'm sure a lot of you may actually have the holdings, SpaceX in your portfolios. So right now the price sits at 163. So the opening price was 150. It was planned to be $135, but the opening price actually was $150. There, it reached a high of, I think, 225. So yes, the high was 225, and on the same day, it closed at 184. Right now, the price has corrected and it's sitting at 163. So I just thought that, since everybody has become so much interested in this stock, I should also give a review on this. So as we know, it's valued at 1.77 trillion, which is being questioned by a lot of people. And this was the largest IPO in history, and it raised 75 billion for a 5% share float. There was massive volatility on the first day, and right now the price seems to settle a bit. Now, what we need to look at in terms of the prices and the valuation is that the first thing which is important is the lock-up period. So what is the lock-up period? So in any IPO, there are insiders and pre-IPO investors who have already been holding large amounts of shares of this company, and they are restricted from selling their shares for a defined period after the listing, which is called the lockup period. So typical lockup periods are between 90 to 180 days, which is 3 to 6 months. And for SpaceX, this means that the earliest insiders can begin to sell the shares between September and December. Okay. So why this matters is because when the lockup expires, a large amount of new supply of shares is going to enter the market. Even if the insiders do not sell immediately and just sell slowly, even then the market would feel pressured because of this added supply. So most IPOs experience some kind of selling pressure in the weeks right before the lockup, or during the weeks before the expiry of the lockup, and once the lockup period expires. So the second thing that you need to understand is that, right now only 5% of the shares have been floated. Only these shares are tradable. This is scarcity, which did drive this rally up to 225. Once the lockup period expires, that scarcity dynamic is going to change. So what should you watch for? You should watch for the lockup expiry date, which is not yet confirmed, but it is something that you should watch out for if you're an investor, even if you have not invested and are planning to invest later. That can actually, give you a good entry point if prices tend to correct further after that. So that is going to be towards the end of the year. And yes, the stock would experience volatility in the weeks before and during those. The other important thing is that the inclusion of SpaceX into Nasdaq and S&P 500 indices. So as we know that S&P has certain rules, and a company needs to be trading for 12 months and needs to be profitable in order to enter the S&P 500. So it's going to take SpaceX almost a year to be a part of S&P. However, Nasdaq has introduced a fast entry rule specifically around this IPO, which means that SpaceX can actually become a part of Nasdaq as early as next month. So, but the good thing is that they are going to give a much smaller weightage to SpaceX as compared to its market capitalization. So there will be only a 1% representation of SpaceX in Nasdaq just because 5% of the shares have been made available right now. Which means that if there are and if you have money in Nasdaq ETFs or other products or other funds which track Nasdaq, that is going to, this smaller representation right now is going to mitigate any big swings which might happen in this new stock's price. And this inclusion is very important. Why this matters for you as an investor? Index inclusion triggers automatic buying of from every ETF and fund which is tracking that index. So for the Nasdaq 100 alone, there are trillions of dollars of assets which are benchmarked to it. So this creates a very powerful supply demand imbalance that supports the stock price. So once SpaceX gets included in Nasdaq and then later in the S&P, it's that's going to create a lot of demand through passive fund buying. So you need to keep an eye on when it will be included in these indices as well as the lockup period that I talked about before. So currently we know that it is priced at 95 times its revenue. So which is again, it's an extraordinary multiple, which requires that, it is able to flawlessly execute all of its long-term roadmap, which has been given to the investors. And as we know that, Elon Musk has said that SpaceX can approximately reach much higher revenue levels by 2030 because of, all the Starlink growth and the Starship launch and the AI centers, which would be in space. And at that scale, he is justifying the current valuation. However, many analysts and companies such as Morningstar are valuing this at much less. So Morningstar values the stock at only $63 per share right now, and CFRA values it at $115 right now. So these are two different viewpoints that I'm giving you. Maybe the reality is somewhere in the middle. So what we have concluded from here is that we need to watch out for a few things. We need to watch out for the lockup expiry date, which is the near-term risk event in this market. And we need to expect some volatility around that date. Also look at the Nasdaq 100 inclusion, which is going to happen very soon. And then the S&P inclusion, which will happen in a year's time. So anyways, if you have invested in it or if you are thinking about investing in it, you need to be accounting for a lot of volatility in the coming time. So I think you should be doing your risk management or your portfolio allocation in a way that you understand all the risks involved on all the volatility which could come. Now let's move on to Bitcoin. And again, this is interesting because a lot of people who had high hopes for Bitcoin are very disappointed right now. So this is the long-term chart for Bitcoin. And yes, actually, it's sitting at around 50% of its highest value. And, this is one question that is in everyone's mind. What will happen to the cryptos? What is the reason why there is so much pressure on them? Are they going to recover? And if so, when? So we had this current all-time high of 126. Right now, the drop is almost 50%, which is quite huge. So the way that we could look at it is that the Bitcoin is in a post-peak correction phase. And there are a lot of factors in the macro environment which are causing this. One of them being the hawkish stance of the Fed. Because Bitcoin has had a dual identity in the past. It started off as something like digital gold. Later, the identity changed to something like a risk asset. And right now, there is a risk-off sentiment in the markets. The Fed is thinking about increasing interest rates, which is putting pressure not only on this market, but also on the metals and also on equity. So this is one reason, but there are other reasons as well. And let's look at some of these reasons. So the high rates is something that I mentioned. Apart from that, there have been massive ETF outflows from Bitcoin. So January 24, Bitcoin ETFs saw around 2.7 billion in outflows, and that reflected a rotation into AI and semiconductor stocks. The second reason is the geopolitical risk, which because of the conflict and the ongoing macro uncertainty that actually pushed investors towards more towards the perceived safety of cash and maybe treasuries, in some cases traditional assets like gold, rather than more risky assets like crypto. And another reason is the stronger dollar. So, because of the stronger dollar, most global crypto purchases are priced in dollars. And when the dollar strengthens, buying pressure from the non-US investors declines. So, if we look at the structural case, which is the long-term case of Bitcoin, and also now look at the supply side, which is interesting because we know that there is a limited supply of Bitcoin. We know that there are halving events every 4 years where the reward for mining is reduced to half, which means the supply shock that suddenly enters every 4 years, and it's experienced in Bitcoin. So there was the last halving event was April 24, which reduced the new Bitcoin supply entering the market. And historically, the 12 to 18 months following this halving event have the strongest price appreciation. So that next event is going to be in 2028, where I think that, which is something that will give major support to the price of Bitcoin. Another thing to understand is that there has been a lot of institutional adoption of Bitcoin. So we still have ETFs holding millions in Bitcoin, and they are not any short-term positions; they are long-term positions. So we still have institutional holders which don't want to sell at this level. And if we look at Bitcoin technically, it's sitting at a very interesting level. So we had a previous support here, and we need to look at how price will behave at this level. So right now we are sitting at a support, and if price breaks below 60, then definitely I don't have more data here, but definitely I'm looking at the next support around 40,000. So if price is unable to sustain itself at this current level, which is an important support level because we did experience a lot of consolidation here in the past at the same level, if you see. So we had consolidation from February to September of 24. So this is a long period of consolidation, which does happen to make a certain level very important and to give support. However, if it's unable to hold at this level and it breaks further down, then the next level we are looking would be this level here, which is around 40. If it's able to sustain itself, we could be looking at observing price action, and any strong bullish price action signals might mean that, buyers are back in the market. But then again, that would also mean that a lot of changes are happening in the economy. We would be more clear about the interest rates. We would be more clear about the future of the conflict and so on. So Bitcoin is again in a post-peak correction phase, but there are also a lot of macroeconomic factors which are right now not supporting not just Bitcoin, but also other risk assets. It's sitting at approximately 50% below its all-time high, and it is experiencing the type of drawdown that does. We have seen these drawdowns before after an accumulation event. And we have the same kind of macro headwinds that have driven it lower, rates higher, a strong dollar, and there's a risk of sentiment. They are all present. I think that right now we should be on the sidelines and, observe again how the macroeconomic environment and the factors that I talk about unfold. And yes, the direction will also depend heavily on the decision of the Fed regarding the interest rate and whether the risk appetite returns back to the market. So I think that I have discussed everything. If there is any question regarding anything that I've discussed today, please feel free to ask me. Now I'll look at the Q&A. I have a question. The current US stocks are at an all-time high. Is it good to enter stocks ETF whenever there is a small correction opportunity? Actually, the nature of the US market and the nature of the stocks is that they will almost always run on an all-time high. They will always make all-time highs. And I have mentioned this before that there are a lot of reasons for this. If you look at specifically the S&P, we know that it is a collection of the top 500 companies by market capitalization, and whichever company, for whatever reason, becomes the wealthiest and has the biggest market capitalization will have the greatest weightage in the index. So right now, it is all of the AI companies that are that form the majority of the index and are driving this forth. So this is actually a very real or a very structural reason. I would not call this a boom, or I would not actually call this a bubble, because there's an actual reason why we are seeing these gains. AI is real and the technology demand is real. I think that, this is something that has continued to happen as, we have always experienced technological progress, and that's going on since over 100 years. And over 100 years, the stock market is increasing in value, for whatever reason. But technological progress is something that is going to continue. And in my opinion, we are going to, despite the dips and despite the crisis, we would see increase in value. Also looking at the fact that inflation also inflates values over time, and it's a process that continues. The values keep on increasing. I do think this is a very, very good market to, if you want to invest in the long term through an ETF. And an ETF is obviously, a fund which is tracking something like an index such as S&P or Nasdaq or any other index. With regards to ETFs or long-term investments in stocks, data shows that it does not really matter how you time yourself. And people who have actually bought at all-time highs versus the people who tried to time and tried to buy dips. So long-term data shows that they both have had the same results, and they both have had the same kind of returns. So this is not something that I am claiming, but this is what data shows. So if you just check this yourself, you will know that precise timing is actually it's not possible. I don't think that anybody can precisely time the dips all the time. So yes, I mean, if you have captured one major dip, I think it's a good idea to maybe add to your investment. Like, a lot of people would keep on adding to their investments, which is called dollar cost averaging. So they will keep adding a certain amount of money every month to their investments. So that can be a good idea. But then again, you all have to understand that whenever you're investing, that definitely comes with some risks. And before you invest, you need to have an emergency fund of at least 6 to 8 months, and you need to have paid any debt, or you need to have, that money only which you think you can invest in the long term, and you will not have the need to withdraw this money. And I think that having a long-term perspective is going to be much safer because it will insulate you against different types of market conditions. And again, ETFs will not involve leverage. So you will be buying with whatever money you have. So again, that risk that comes with leverage is not going to be there as well. So you're asking about a demo account. Somebody has asked if there is a demo account. We generally don't have a demo account on the Amana app, but you can just email us and request for one, and then the team will respond to you. Someone wants to know how to put a stop loss in the Amana app. So in order to put a stop loss, you need to open this order ticket, and you see protection here. You need to click this button here. So once you click this, you see SL, which is the stop loss. So here you need to be putting the stop loss price, which is going to come from the price chart. So for example, if the price right now is 7,400 and I want to put a stop loss at, let's say, 7,200, I will have to put in the stop loss price, okay? So 7,200 for S&P is going to be my stop loss price. And if the price comes down to this level, my trade is going to be closed automatically. So I can put, let's say if I put 5 units here, and if I put a stop loss price of 7,200, so here, this is showing me the amount that I have risked right below the stop loss. So I've risked $100, sorry, $1,000 at these units and this stop loss. So no, you don't have to put the stop loss amount or the risk that you have taken on the trade. It has to be the stop loss price. This figure here will automatically show you the dollar amount which is at risk at your chosen stop loss price and at your chosen number of units. So we have that option. So for the amount that you are investing, we have the option of putting your either in an amount, dollar, or in number of units that you wish to trade. So you can change the quantity to either units or amount. But for the stop loss, you have to put the price. If you need the leverage to be changed, then you have to send us an email. You cannot do that directly from the platform. So a lot of people have asked how they can change the leverage on a certain product. If you want to know how much leverage there is, just click on the asset and go down, scroll down, and you will see the leverage. And if you click here, I think yes, you can request for a change of leverage here. And this table is showing you the different leverages that we offer for different products. Again, someone has asked, what is a safe leverage? There is no safe leverage. Actually, risk management is something that you have to do yourself. So I have given webinars on risk management, and I've explained that what you have to do is you have to come up with a certain dollar amount that you are comfortable risking on a trade. For example, let's say you have a $10,000 account and you are comfortable to risk $500 per trade. You take that $500 and divide that by the stop loss size. So you need to first decide the risk on the trade. The second thing is you need to decide the stop loss price and then calculate the units accordingly. So I'm not going to go into details because I have done webinars and they are uploaded on Amana's YouTube channel under risk management. So if you calculate your quantity according to your set risk and you control the number of units that you trade, then leverage does not become a concern. So in that case, leverage will not be a concern because what you're doing is you're sizing yourself and you are reducing the number of units to match the risk and the stop loss that you have chosen. And if you get stopped out, just in case, then you would be losing exactly what you planned on the trade. So then leverage will not be of concern in that case. But if you want to have a specific leverage for a certain instrument, then like I said, you can just request for a change here. I think I've answered most of the questions. So thank you for attending today's webinar, and I will see you next Tuesday.